What's going on, guys? Welcome back to another video. We just had another wild day in the market. We had a very strong recession indicator trigger today. We're going to be covering that. We had some more economic data that came out that is kind of in furtherance of that data, and one of the reasons why we might be seeing this indicator actually trigger. We also have some more updates on what's going on with the rate cut expectations. I mean, you guys can probably tell at this point, the expectations for a 50 basis point cut coming at the September FOMC meeting are starting to move higher. And also, one of the most dangerous things in the market right now, the Japanese yen, is starting to strengthen again, which does not bode well for the entire market. So let's get into all the information, guys. As always, if you guys do enjoy these types of videos here, make sure you go down, drop a like on this video. And if you do have any questions, make sure you guys comment them down below. But first of all, I want to go over this absolutely epic trade that we took today. I mean, if you guys were along with us on the stream, and especially for those of you guys in the Discord, you guys know exactly what we are looking for. Remember, everybody gets 2 weeks free as a part of the launch. Again, everybody loves to come in here and think that trying to scalp these 1, 2, 3, 5-minute candles is what's going to make them have success long-term in the market. Guys, information is the only edge that matters. In trading these longer time frames is going to give you such a increased level of confidence in these moves. The moves are bigger. For those of you guys that have 9-to-5 jobs, this is perfect for you guys, and also all the day trading stuff that we do as well. But again, slightly differently than you have seen on the internet before. So if you guys are interested in that, make sure you guys check out that link down below. This one is off to a very, very hot start, and there's going to be many, many more to come, guys. But let's just first take a look at the yield curve right now. So this is the 10-year minus the 2-year. And as we can see right now, we are just starting to get above this neutral or zero area. What they're doing here is taking the 10-year yields and subtracting them from the 2-year yields. So when the 10-year yields are less than those of the 2-year yields, and that's talking about the time to maturity, then you would say that you would have an inverted yield curve. But let's actually go over exactly what this means. So right here from Investopedia, let's just break this down simply. Yield curve is going to graphically represent the yields on similar debt securities across a variety of maturities. So when we're looking at those treasury yields, those are those similar debt securities across a variety of maturities, those 2s versus the 10s. An inverted yield curve forms when the short-term debt instruments have higher yields than long-term instruments. And that's what we have been in really since the middle of 2022. An inverted yield curve historically is unusual. A normal yield curve would be sloping up, meaning that those maturities with longer times to maturity there. So the 10-year versus the 2, the 10-year should typically have a higher interest rate or a higher coupon rate on those bonds. Now, what people like to say is that an inverted yield curve, which is what we've been in for a pretty significant period of time now, is a pretty good and reliable recession indicator. But there's not really a time frame on it. It's not like the yield curve inverts and you immediately go into a recession. But when we come over here and we take a look at these yield curves here that we've seen historically, what do we notice happens right before these big periods of these historic recessions? So this is the neutral line that we can see here. So we can see the yield curve inverts, uninverts, recession. We can see the yield curve inverts, uninverts, recession. Inverts, uninverts, recession. Almost inverts here, uninverts, recession, and that's when we had 2020. Now, the interesting thing about this is, since we are in such an interesting environment here where the yield curve has been inverted for such an extended period of time, and the inversion that we have seen has been one of, if not the deepest that we have seen historically, this situation could be a little bit different. But what I want to bring up here as well, guys, is these job openings than this data that came out today. So what are job openings effectively telling us? Well, if there are more job openings from this data, if this number that we see right here on job openings are increasing, it means that companies and employers are looking for more people to bring into their business. Because why? They want to expand. They have more growth prospects. They have more things in day-to-day operations that they need more employees to do, which is going to signify growth. Now, the exact opposite is true when you see job openings moving to the downside. This is showing us that these employers are not as willing to hire new employees, signifying a lack of growth over that period of time. And that's what a lot of people have been worried about since really the middle of or the beginning of first quarter ish, leading into the second quarter of 2022, all the way up until now, on this most recent job openings data. Now, we have seen blips where it starts to move back to the upside, but overall this has been on a downtrend. Now, when we come over here and take a look at the CNBC kind of report in the brief here, the labor market is no longer cooling down to its pre-pandemic temperature. It has dropped past it, says Nick Bunker, head of economic research at Indeed Hiring Lab. Nobody, and certainly not policymakers at the Federal Reserve, should want the labor market to get any cooler at this point. And that is one of the reasons why we are seeing the reaction in the bond market, why we are seeing the yield curve uninvert, and also why we are starting to see the 50 basis point rate cut expectation for September here really starting to move to the upside. So let's look at September. We saw going into yesterday, we had a 38% probability of that occurring. Right now, according to the Fed Watch tool on the CME Group's website, we have a 45% chance versus yesterday, the 38% chance of a 50 basis point rate cut in September. Now, looking at December here, this is the data that I've been looking at the most recently, as you guys have seen in these videos here, where when we take a look at these three outcomes here, and again, this one is starting to sneak in here, this basically 125 basis points of cuts, that is a bit aggressive. If we are going to price in and start to price in more of this 100 basis points of cuts area, and you can just tell that it's 100 because we're currently sitting at this, actually that's 125 basis points. That is big. So we're really pricing in a full 100 basis points by the end of the year, and we are starting to significantly move up on these 125 basis point cuts. And remember, there's only 3 FOMC meetings left in the year, meaning that if they're pricing in 125 basis points of cuts by the end of the year, then that would mean that we need to see not one, but 2 50 basis point rate cuts in either the September, November, or December FOMC meeting. So guys, the other thing that's going to be really important going into the end of this week is going to be non-farm payrolls on Friday. That's going to give us a really good indication of what's going on. Additionally, in the labor market, we're going to get the unemployment rate, average hourly earnings, and that's going to be that last piece of the puzzle that the Fed is going to be looking at to determine what they are going to do at that September meeting. Now, because of all of this going on, we are seeing some drastic movement in the currency market as well. If you guys have been paying attention to these videos, guys, this is so important. I cannot stress this enough, how important knowing and understanding, or at least having a basic understanding of these big macroeconomic events happening, whether you're an investor, but specifically if you are a trader. Because again, information is the edge. You're going to have a lot of people running around in the market that don't know these things. And the fact that you guys do is giving you guys an edge in the market. So what are we looking at here? Well, this is USD JPY. When this chart is moving to the downside, it means that the yen is strengthening versus the dollar. Now, if the yen is strengthening versus the dollar, what are we seeing? Well, remember, a lot of these big hedge funds were taking out loans of Japanese yen, converting it into US dollars, and then buying US equities or bonds. If we start to sell off even more on this chart here, the risk for more unwinding of the carry trade is going to significantly increase. Now, what does that mean? Well, if they have to unwind the carry trade, or their element or their positions within the carry trade, what that means is that they either have to go out and sell U.S. bonds, or they have to go out and sell U.S. equities, which is the main reason why we saw this significant sell-off at the middle of July going into August. And as I said a lot, I do not think that JP Morgan was correct in saying that 75% of the carry trade was unwound in a matter of like 3 or 4 days. You can't have a almost decade-long, wildly over-leveraged position or trade that these big institutions were putting on that all of a sudden got unwound. Most of them are out of it, and nobody had any significant issues, meaning you didn't see any of these big funds starting to either blow up or take significant losses. So what are we looking at right now? Well, The sellers are in control of this market. I could easily see us continuing to move to the downside here, and that's perfectly fine. That gives us the ability to get really, really, really solid setups going into the next couple of months when we eventually see this market turn back to the upside here. Now, remember, we talked about this in yesterday's video, the seasonal effects or the seasonality that a lot of people like to bring up, thinking about September and October, just historically, and then also when you tie that into it being an election year. These 2 months typically aren't the best for the market. I mean, again, I'm not the biggest fan of thinking about the market in that way. I like to think of it from a very neutral perspective. Like if we had some really bullish earnings, some great economic data, we weren't witnessing the inflation that we are, I mean, we'd probably trend up in the month of September and October. Now, again, that being said, the people pointing to seasonality are currently correct right now, but it's not something that I would necessarily start to take trades based off of. So here's kind of what I'm looking for going into the rest of the week here. We really need to look and see which sectors are performing well. If utilities are remaining to be a relatively hot sector here, I mean, you can look at XLU. Guys, utilities are not going to continue ripping like this in a bull market. They just aren't. If you're thinking about wants versus needs and the overall economy, the fact that people are starting to pile into things like utilities, XLRE here is another interesting one. This is the real estate ETF. Again, there's a couple of other things going on with this. You could think about this in terms of, well, the safety trade in terms of REITs, real estate investment trusts, people trying to go in and get some form of yield on the capital that they have. They could think that some of these properties that are in these different real estate companies that they're holding could potentially start appreciating in value with the declining interest rate environment that we're likely to go into. The other thing that we've been taking a look at here and keeping an eye on is healthcare. That's a pretty nasty daily candle on XLV here, so I would be relatively careful in the healthcare space. But again, times like this in the market, guys, are not the time to go absolutely crazy. What's going to make you a successful market participant and trader over the long term is knowing when to put your foot on the gas and when to relax a little bit and say, okay, there still is opportunity in the market, but it is not the time to I mean, you shouldn't do this ever, but over leverage yourself or take on too many different positions unhedged. So I know a lot of you guys are going to be coming from that hedging webinar that we did do in the Discord this evening. So that's going to make a lot more sense to you guys. But again, that's going to wrap up this video here, guys. If you did enjoy this one, make sure you guys go drop a like down below and make sure you take advantage of that launch promotion that we have going on to the Discord right now. 2 weeks free for all of you guys. That is going to go until the end of September. And after that, it's going to be waitlist only. So team, that's going to wrap it up for this one. Peace.